Hello, everybody. What a great panel that was, and what a great morning we have had. My name is Sandeep Pai. I'm an executive in residence at the Nicholas Institute for Energy, Environment, and Sustainability. Most of my work is on emerging markets. So I am really thrilled to be moderating this panel, focusing on risks, returns, and reality in emerging market climate investment. I just want to set a little bit of context before we dive in, before I introduce the panel and then dive into some really thorny questions of how do we move capital in the emerging market, which is so crucial to meet any climate targets. So I just want to start with the big picture here. The big picture is that the world has already warmed by 1 degree Celsius. In fact, in 2024, we had for that particular year, we already had 1.5 degree warming of surface temperature. What that means from an emerging market point of view and a lived reality of millions and billions of people is that people are facing floods. I mean, this is true in advanced economies as well, but this is really true in emerging markets that people are facing floods, people are facing fires and droughts, and it's a big lived reality as it's playing out. To contain further rise in temperature, meet Paris targets, I think we need finance in 5 buckets. So let me just take you through one by one. The first one, very easy, most of the world is focused on that, is the clean energy bucket. So the bucket where you want to deploy solar, wind, electric vehicles, lots of excitement, lots of projects are really bankable. There's an exciting space. The second, as we heard in the morning session, we should focus on carbon removal technologies, because if you look at any modeling study, I've worked in modeling for years in integrated assessment models, you'll find like the degree of carbon removal required to meet these targets is enormous. So massive investments required, especially in emerging markets, because all the different technologies are growing. The third is phasing out fossil fuels and the just energy transition, the underlying just energy transition that is required to close down power plants, mines, and the need to take care of communities and workers, the equity side that the secretary mentioned in the morning. Fourth is investments in adaptation and flood systems, in better seeds for agriculture, weather monitoring. And the fifth is loss and damage. So we have these 5 buckets where we need massive investments. From the finance side, I mean, some of these projects are bankable, some of these projects will not be bankable, and there is a big gap. And we see from the data, from our colleagues, Bella has joined online, and from many others, that there's a huge gap in finance that needs to flow in the emerging market. I'll leave those numbers for Bella because I've teed her up to talk about some of those numbers. It's not just a question of are we scaling enough finance, it's also a question of where exactly is it going to which countries within emerging markets. And I just want to remind why emerging markets matter. Emerging markets and developing countries, even if you exclude China, will be 66% of global population, massive future emissions growth, and dire need for adaptation, even in the current situation. So given all that, I think this is really an honor to moderate this panel to see how we can bring investments in emerging markets. And we'll tackle questions like how do we bring adaptation finance? What are the different instruments? What are the risks? What are the realities, et cetera? And so we have an excellent planner, and I have the hardest job today of moderating with 4 excellent guests for 45 minutes. And I want to get so much out of them, but we have only 45 minutes. So I'll start by introducing our panel. We have Bella, who unfortunately could not join us in person, but we're glad that you could join us online. So Bella Tonkonogy is the Senior Director for Global Programs at the Climate Policy Initiative. Jorge Ordonez, Director for Sustainable Finance, Global Sovereign Solutions at Citi. We have Rob Santangelo, Global Head of Energy at Santander, Corporate and Investment Banking. And lastly, we have Moses, who is the Managing Director for Sustainable Finance at RBC Markets. So I want to start with Bella. You get to start because you're online. Set the big picture for us. Tell us, what are the gaps in climate finance? What are the numbers, especially when it comes to emerging markets? Which are the sectors? I highlighted the 5 kind of gaps, but which are the sectors where more money is flowing? And lastly, you could end by explaining what are the risks and what are the perceived and real risks of investing in emerging markets.
Sure, thank you so much, Sandeep, and hello everybody. I'm so sorry I couldn't be there in person, but it's very glad to be able to be here virtually today with you. So CPI, my organization, one of the things we do is we track global finance flows around the world. We release every year something called the Global Landscape of Climate Finance, and last year we also released a version of that global landscape that was really diving much more deeply into emerging markets and developing economies. And so I'll give you some data that is from those 2 publications, just in case you want to follow up and get some more information later. But just starting globally, one thing I think that is, I like to start with is this very positive story about climate investment globally over the last 10 years or so. We went from tracking about $300 or so billion annually globally of investment in climate solutions. That's anything from renewable energy, electric vehicles, forests, nature, agriculture, sustainable agriculture. So we went from tracking about $300 billion annually to, in 2024, exceeding $2 trillion. So we've had enormous growth around the world in climate investment, and that's a really positive story. And it's largely been driven by increasingly cost-competitive renewables, and now even more investment in electric vehicles and charging infrastructure. Most of that investment has happened in advanced economies, countries like our own, in Europe, Japan, as well as China. China is still considered an emerging market, so some of the numbers I'm going to talk about now do include China. And so when we look specifically at emerging markets and developing economies, just to echo something that Sandeep said, which is that they're absolutely critical for addressing climate change. They account for the vast majority of the global population, including China, over 40% of the global economy. And so really the success of climate transition and their climate transition really will determine the course of global emissions for decades to come. So this is a really important topic to make sure that we all understand and can support. So in terms of emerging markets, in terms of annual investment, we're seeing more than $1 trillion annually in and within these EMDEs, that's emerging markets and developing economies. And I think there are 3 distinct narratives here. First, there's China, again, still considered an emerging market. It's the global leader both in production and deployment of clean technology, and it accounts for about 2/3 of EMDE investment in our latest analysis. So then you have a group of countries, the other emerging markets. Those are countries like Brazil, India, Indonesia, South Africa, Mexico, Thailand. They add about another 30% or 1/3 of total EMDE investment. There's a lot of opportunity in those countries. They're moving very quickly on climate transition. Many of them have fairly sophisticated capital markets. Some of them manage currency risk well, not all. And then finally, you have a very small slice that are least developed countries. These are countries that are just getting a very small amount of total climate investment, around 4%. These are the most vulnerable countries in the world, and especially vulnerable to climate impacts because they are very dependent on natural resources for their economies, in particular agriculture, and mostly smallholder agriculture. And so these are the economies that are maybe not big heavyweights in economic growth around the world, but are really important in terms of their vulnerability, their fragility. And so we do need to pay attention to them in terms of climate investment as well. So maybe just last point, I'll say most of the finance is mitigation. There's relatively less finance going to resilience. And I think, as we move further into the discussion, really thinking and understanding the variation, both in these kind of three big buckets of emerging market investment, but then also within the countries, is really important. They are not all the same by any means. They all have kind of different risks, different risk profiles, and so really understanding them in detail and granularity is absolutely important for being able to catalyze more investment in these countries. So I'll turn it back over to you for now, Sandeep. Thank you.
Yeah, thanks. Thanks for explaining in the three buckets. So let's stick to the bucket number 2 and 3, which is kind of a bucket of India, Brazil, South Africa, minus China bucket, plus the really least developed bucket. So that's a great point to bring Jorge here. Your work at Citi, you focus on sovereign solutions. If you were an advisor to a finance minister in kind of an emerging market, what would be your advice? What do they need to change internally to bring in large pools of capital?
Yeah, thank you, Sandeep. I think one of the main actions that any government can take to attract private capital at scale for climate infrastructure in general, it's really to create an enabling policy and regulatory framework that removes structural barriers to investment. And it's really going back to basics. Private capital allocation for infrastructure in emerging markets depends on project risk and country risk. And while project risk is inherent to any infrastructure investment, both construction and regulatory hurdles become more difficult to manage as you go down the sovereign credit rating scale, where economic and fiscal strength is lower, governance and institutions are weaker, and event risks are higher. So I just going to give an example of a model that has emerged to deal with some of this, and it's the country platforms, which have emerged in the last few years. And these country platforms are a construct to attract strategic partners, funding, and investment for transformative projects in critical sectors and to support climate action. These country platforms are anchored on policy reform to de-risk long-term investment, and also on coordination with multiple stakeholders like development banks, donors, philanthropies, and private sector, to attract public and private capital to priority projects under a strategic investment plan. So some examples of these country platforms includes Brazil Climate and Ecological Transformation Investment Platform, which has identified 17 projects worth up to $25 billion in investments across 3 different sectors: nature-based solution, industry and mobility and energy. Egypt's Water, Food, and Energy Nexus program supports projects in those 3 sectors. And the Just Energy Transition Partnerships in South Africa, Indonesia, Vietnam focus on climate, on coal phase-out, as you were saying, the just transition, renewable energy generation, and grid expansion and modernization. These country platforms, they set to address a number of issues. One of them is to set a clear direction of travel in terms of concrete and project-driven renewable energy and decarbonization targets that are also broadly aligned with NDC commitments and sustainable development strategies. They look to identify policy, regulatory, and project-specific actions required to enable private capital investment. They want to align public and concessional funding to de-risk private sector investment where necessary. And finally, they finance project preparation and structuring to build credible pipelines of investable projects in specific sectors. These platforms recognize that there needs to be collaboration between the public and private sector to create that enabling environment through policy, regulation, and financial de-risking. And the extent of those policy reforms really varies by country. If you look at the JETPs, they focus more on broad sector reforms that include, for example, improving renewable energy procurement processes through RFP standard documentation, streamlining land acquisition and permitting, relaxing local content requirements, standardizing power purchase agreements with equitable risk allocation that can be applied to projects across the spectrum. And they improving, removing fossil fuel subsidies, applying renewable energy tariffs that are cost reflective, improving transmission and renewable energy generation systems planning so you can know exactly what your generation need and where the grid constraints related to it. When you see at Brazil, they have a more tactical approach. They created a compliance carbon market with a cap and trade system. They created a sustainable investment taxonomy. And they came up with this eco-invest mechanism that aims to attract foreign and long-term capital through various instruments like using catalytic public funding in blended finance structures to reduce cost of capital, long-term liquidity effects facilities to help companies meet obligations in foreign currency, currency hedging programs to reduce the cost of long-term hedges, and again, the financing, project preparation, and structuring. Right. And very quickly, this last part is very important, project preparation, and as Jackson was saying, shovel-ready investable projects, which are not present for the most part in emerging markets. You have governments with lists of projects that don't have the necessary levels of due diligence that financiers and investors require to analyze a project and to structure financing around. And historically, MDBs have filled this gap on a project-by-project basis, but maybe a more permanent solution to that is to have strong public-private partnership units within ministries of finance that can help prioritize projects and build that pipeline of investable projects that can help fund, oversee, and coordinate project preparation, that allocate risks within clear PPP frameworks that use standardized concession agreements and transparent procurement processes, and that coordinates with Ministry of Finance in terms of the nature and quantum of the government financial support to infrastructure sectors in line with fiscal parameters.
Yeah. No, thank you. That's great. So I think these country platforms could play that anchor role in terms of giving really good policy signals and regulatory signals for investors. That's a really great way to bring Rob into the conversation. Yeah. If you're an investor who has invested most of their investments in US and North American market, now why should they care about investing in emerging markets? Like, what is in them? Why would you what is your advice to them? How do you tailor them to invest?
I think we've seen an ebb and flow of investment interest in emerging markets. So our bank, we are very active in the developed world, and we're very active in the emerging markets, primarily in South and Latin America and emerging markets. And there is actually pretty good penetration of renewables in those markets. And generally, I'd say relatively good availability of funding. So project funding typically works at a 60 to 70% level. Trade finance can get that to kind of 70 to 80. I think that I do think in some sense that you'll see the same investor complexes investing across developed and emerging markets. Oftentimes there are different funds within the complex. And then sometimes it's a large master fund that will have a target 20 or 30% to emerging markets. And I think that, as they think about it, there's obviously emerging markets present generally higher rates of growth. Now, maybe with AI, that's in question, and that's sort of an additional source of competition.
Right.
As returns and renewables in developed markets have gone up, because if you think about what's happened is, in the current day, power costs are not a driving factor of data center economics. And so there's been a willingness to pay up a little bit to get that. And if that means the return goes up a little bit, that's acceptable. And that has pinched a little bit, if you will, the gap between the developed market return and the premium that you are getting to go into the developing markets. And I think that in the case of the developing markets, it becomes hard to step up that rate because of ability to pay or cost constraints that are more significant. So I'd say that we typically see investors, some investors, I'm only this, they're a smaller fund. But if you're a big global fund manager, you probably have an allocation in your main fund to emerging markets, and then you probably have dedicated emerging market funds. And I think they look at it as, generally speaking, a little higher risk, but a little growthier market and a little higher returns. And they're going to look at the stability of the framework. I mean, renewable energy investments return their capital pretty slowly. And so you can give a little bit more of an upfront incentive, but if there's not a perception of stability, that upfront payment is illusory. Right. And so this perception of stability in local market, managing currency risk, et cetera, I think are essential. So I would say we still see a good degree of interest in operating projects in the emerging markets. I think there's probably more caution right now on projects that need more development work. There's certainly more interest in projects where your off-taker is a multinational, a mining company. You can get US dollar payments. I mean, there's been a lot of creative solutions to attract capital. And I think generally, I don't know, Jorge, Brazil 80, 85% between hydro and renewables. Some of these markets are pretty deeply penetrated, right, and functioning pretty well. Mm-hmm.
Great. Moses, how can institutions like RBC leverage both market building capacity and internal balance sheets, because you use some of your internal balance sheets to really scale up climate investments in emerging markets?
Yeah. Well, no, thank you so much, Sandeep, for organizing the panel and for the opportunity for everyone to be in this room today. Before I kind of dive in, I do want to just say, I know I'm at Duke. I do root for Michigan, so congrats on the win. And I will come back to an analogy to March Madness in some of my commentary in a minute. But for those that don't know, RBC has, Royal Bank of Canada. We are a Canadian bank. I sit within our capital markets organization. On any given day, we're about the 6th or 7th largest North American bank. We have the highest credit ratings. And actually here in North Carolina, we have a pretty large presence in Charlotte, where we do our community investments work, which includes affordable housing. Our tax equity business is headquartered in Charlotte. But one of the things I just wanted to say is that, similar to Rob, our footprint is largely in developed markets. So think North America, Europe, Asia, Australia. But when I think about kind of the three principal ways, and I want to leave the room here with a sense of optimism, financial intermediaries have a very important role to play to mobilize capital. The topic here is billions to trillions. So how do we actually move large quantums of capital into emerging markets to help solve for mitigation, adaptation, resilience, et cetera? So the way we principally do it at RBC is, one is we facilitate capital flows through development organizations. Two, we facilitate capital flows through multinational corporations. And last but not least, we leverage our own balance sheet. So we're putting our own capital at risk principally through funds and through innovative companies. So firstly, just in terms of what we're doing with development organizations, as most folks know, there's a very robust and mature market of multilateral finance institutions, development finance banks. We spend a lot of time with the World Bank, IFC, African Development Bank, et cetera. Last year, in fact, we did nearly $60 billion in US dollar equivalent of financing for these types of institutions. That capital is going to work in emerging markets context. The one thing I will say is from a risk and liquidity perspective, given the shareholder base of these types of institutions, they're largely AAA rated. And thus, there's a lot of efficiency and liquidity for these institutions to raise capital at large sums and then deploy them into the emerging market context. Just to give one example, one of our clients is the African Development Bank, which is headquartered in the Ivory Coast. Over the last 5 years, we've helped them raise around, let's say, $7 billion US dollar equivalent. Some of those financings include both green and social bonds. Of course, those types of financings have very discrete use of proceeds around energy access, development, energy efficiency. And so some of the projects, if you just kind of look through the capital that they've raised and the projects that are financing, include things like hydropower in the emerging market context. We also just recently led a transaction for the Inter-American Development Bank, the IDB. They raised their inaugural Amazonia bond, which is very interesting. It was a 5-year, $1 billion Aussie deal. And that transaction, the use of proceeds are going to do things like biodiversity, sustainable development projects, specifically in the Amazon. The second sleeve I mentioned earlier is what we do with corporates. And so we have clients that have footprints all over the world. One is near and dear to my heart because it was my former employer called Orange. Orange is one of the largest global telecoms in the world. With about 300 million mobile subscribers. And they're headquartered in France, but they have a very extensive footprint in Francophone Africa. So, Bella mentioned least developed countries. Many of those countries that they represent are LDCs. And we represented Orange in their issuance of their inaugural sustainability bond back in 2022. Again, the proceeds are going to do things like energy access, renewable energy, et cetera. And then lastly, how we're touching directly with our own balance sheet is RBC announced the commitment to mobilize from our own balance sheet $1 billion Canadian into climate innovation. So we've backed to date 10 funds, such as Energy Impact Partners, General Atlantic Beyond Net Zero. Some folks will know Generation Investment Management. They have a Just Climate platform. We're putting not client money in, we're putting our own balance sheet into these funds with the express purpose to help them innovate and find opportunities to invest, but also to work with those companies. One of those companies that General Atlantic has invested in is called King Energy. King Energy is one of the largest pay-as-you-go solar businesses in Africa. They allow households to have light and pay as little as 19 cents on a daily basis. And this is a better alternative than kerosene lamps in some of those markets. So we're really excited about kind of the 3 ways that we're engaged with emerging markets. But I would just say, as the secretary mentioned this morning, and I think it was Christine, I leave with a pretty good sense of optimism that markets are efficient and capital is flowing into these markets.
Right, great. Great, and then we heard a lot of examples about country platforms and different examples, but a lot of them have one thing in common that I'm reading, which is it's mostly geared towards clean energy or in large part. I want to focus on adaptation, and I think it'll be a big miss if we don't focus on adaptation finance. So I'll start with you, Moses. How do we make adaptation more fundable?
Yeah, I mean, I should give a shout out because the Climate Policy Initiative actually wrote some research a few years ago, Bella, where they actually did probably one of the only mappings we could find on the delta between mitigation investment, which at the time that report was like 1.8 trillion in mitigation, and something like, I forget the number, maybe it was like 50 or 60 billion in adaptation. But suffice it to say, we are seeing an enormous amount of interest from investors on climate adaptation with the express purpose to identify solutions that prevent, respond, and recover from extreme incidents due to climate. Whether it be wildfire, flooding, we are seeing all sorts of interesting solutions emerge. But maybe I'll just bucket it into kind of three ways. One is, I think, from a fixed income and infra perspective, those types of opportunities are executable today. Right. Two, from a private capital perspective, we are seeing green shoots emerge. And then lastly, from an equity markets perspective, we're seeing really kind of an under-tapped opportunity. But maybe just to go through this quickly, from fixed income and sustainable infra, particularly with municipals and investor-owned utilities that have grid hardening objectives, we're seeing pretty robust issuance for adaptation and resilience solutions. We actually priced a deal for a state public benefit corporation called Battery Park City Authority. So if you ever go to Lower Manhattan, the World Trade Center, all of the west side of Lower Manhattan is kind of overseen, the real estate that is overseen by BPCA. And BPCA had a lot of, that area was impacted pretty negatively after Hurricane Sandy in 2012. Mm-hmm. And so in December, they raised $700 million in sustainability bonds, and they're using those proceeds to enhance the infrastructure in Lower Manhattan. So fixed income, right. Infra, executable today. Green shoots in private markets. Mm-hmm. I think a lot of the climate investors we're talking to, some of which are, GPs that we funded. Right. Many of them are looking for opportunities in the adaptation resilience space. I would just give a shout out. I think Christine mentioned something at University of Chicago, work around floods. There's a company that we like a lot called Floodbase. Yeah. They do flood monitoring, leveraging satellite data. They not only supported FEMA in the while Hurricane Helene was, right. sort of hitting the Carolinas, but they have also done work in places like Malawi and Mozambique. And then lastly, just from an equity market perspective, I'd say we're still seeing kind of an under-tapped opportunity. There's some interesting research that MSCI put out that suggests 11% of public companies actually have solutions on adaptation resilience, so right. a relatively small portion among the public companies they investigated. But we are seeing some opportunities. So Wellington Fund Management, for example, has a dedicated adaptation fund. So yeah. That's right. Kind of it in summary.
Wonderful. Yeah. Just moving on in the interest of time, Rob, on the mitigation side, what are the next wave of mitigation opportunities?
I have to say, I don't see the scale and activity that we see in sort of the lower carbon power space. And I don't know, and I Moses, maybe you can comment, I don't see as many, investments coming at an infrastructure or at a large capital scale to deploy these solutions. Typically we see them around our sustainable finance area where we have folks in the similar seat. They tend to be smaller, more niche projects than the kind of capital that we can deploy into. I think it's a very important sector. Right. I think it's a very immature sector. Mm-hmm. It's a sector right now that probably is more active in many cases in family offices or philanthropic organizations. We just don't see much coming through that we can finance in the sort of large scale finance that we typically spend our time on.
Right. Jorge, I need to ask you this question about green bonds and will they mature and take over concessional finance, or we'll continue to see the world of concessional finance, coming in first, and then, how do we scale green bonds to the levels that are required in emerging markets?
Yeah. And I'm going to answer this again from a sovereign perspective. We've seen a lot of growth in green bonds and sustainable labeled debt for sovereign issuers. I would think that it might be true that a lot of the proceeds go to refinancing of existing balance sheets. But when you look at recurring issuers like Chile, which have fully ingrained sustainability in their funding strategies and national policy priorities, you can see that that's not the case. Right? These type of sustainable debt instruments have a very strong institutional value for sovereigns in the sense that they can help governments increase or strengthen institutional capacity, transparency, and accountability. Because when you go through the process of establishing a sustainable finance framework, where you have to come up with eligible project categories, with criteria to select and evaluate projects, and with guidelines to track and report on allocation of funds and impact, you have to go through an exercise where different ministries have to communicate to each other and kind of like bridge a language gap that was there always, and that sustainable bond markets have helped bridge to some extent. So, you know, when a government has to establish KPIs, targets, deliver projects and initiatives, they have to go through a second-party opinion review. That creates a responsibility for data collection, for reporting, even for identifying environmental and social risks associated to the use of proceeds and mitigants, which are things that not necessarily would have happened in the normal course of budget approval process, right? Now, going back a little bit to the adaptation, I think one instrument that has really changed capital allocation for adaptation are debt for development conversions, or debt for nature swaps. And these are instruments where sovereigns obtain financing at favorable terms to repurchase expensive debt trading in the market in return for a credible commitment to invest the savings of that liability management exercise into impact investments or development outcomes. And they become increasingly popular because they address two issues. One is financing development projects, most of them in adaptation up until now. And the other one is improving debt sustainability dynamics for highly indebted emerging market countries. And since 2021, when there was the first large-scale transaction, there have been 8 of these transactions that have bought back about $6 billion of debt outstanding in the market, and that have freed up about $2 billion for investments in environmental and climate programs. And these savings have been directed to things like marine, terrestrial, and freshwater conservation in countries like El Salvador, Gabon, Belize, Bahamas, the Ecuadorian Amazon, and the Galapagos. So hopefully, you know, these instruments will continue to evolve to make them more efficient and to maximize the benefits, not only for debt sustainability, but for the investments. But I think that's one that is really making a difference in how capital is allocated to this type of projects.
Right. Bella, quick question on just kind of, you know, when we work in emerging markets, one of the things I have always struggled is policymakers don't know what they want in terms of climate projects. What should they prioritize? What should they not prioritize? This is something that was very apparent in the Just Energy Transition partnerships. Do you have any advice for policymakers in terms of thinking about how do we prioritize certain types of projects to make them bankable, to attract investments? We're very low on time. I've been flagged 5 minutes, so if I can request you to keep it a little bit shorter.
Sure, I will do my best, but so I think, you know, and I think reflecting a little bit on what I've heard in this panel, you know, a lot of times what you hear from countries is that, oh, there's not enough finance in my country, we have all these projects, we have our national strategy, why isn't the finance coming? And then you talk to financial institutions, people like the folks on this panel, and they say, well, there aren't enough bankable projects. And I think what we miss is the middle, the actual bridge between that helps increase the bankability of projects on the countryside, and then allows that finance to fund those projects. And for policymakers, I think, going back to what Jorge mentioned, is that the country platforms really offer that bridge. And I think they are a place for many in the international communities and national stakeholders to really lean in on, because what they allow is that the national governments, in particular the ministries of finance, which in most countries are really responsible for financial policy, for budgets, for kind of setting the economic direction of the country, that they, along with national financial institutions like national development banks, state-owned enterprises, who are really in many emerging markets, absolutely critical stakeholders in deploying finance and public-like finance, that they can work together with international stakeholders and domestic ones from the private sector, as well as the multilateral development banks, other donors, other development finance institutions, to really turn the national strategies into something that's implementable and investable. And so that process of doing that can be quite lengthy, it can be difficult, but it's absolutely crucial to get everybody to pointed in the same direction with real clarity on what a coordinated strategy is for that country for addressing at least part of their strategy, whether it's energy transition or resilient infrastructure development or whatever it might be, that there is that bridge between the demand for projects, let's say, and the demand for finance and the supply of that finance. So I think that this is the space that is increasingly important, and there are increasingly good models for countries to adopt as they seek to increase investment in their climate transition. And I think there's a lot of opportunity here as well.
Yeah, thank you so much. I've been shown 1 minute, so I'll stick to the time. And I just want to say that what a great set of issues we tackled. We talked about, country platform adaptation, what would an investor think, and finally, how do we bring reforms in some of these countries and thinking to really move climate finance in emerging markets. I just want to give a round of applause to our panelists and say thank you. And we learned a lot. And